ILS and cat bond markets are booming, and the ripple effects are being felt from reinsurance pricing and capacity all the way through to the primary market. While some would question the staying power of the alternative capital behind these vehicles, low interest rates and cat losses make the market attractive. Here at SIFMA's Insurance and Risk-Linked Securities Conference in New York, we spoke with several industry experts about what's driving the market and where it's going in the future. First up is Gary Martucci, Director at Standard & Poor's. Here are the highlights.
From S&P's perspective, we're looking for 2015 to be as active a year in cat bond issuance as 2014 was, though we're not sure if issuance will be as high, only because there were a couple of significantly large deals last year. There was $1.5 billion and a $750 million issuance, and whether or not the similar sized transactions occur will yet to be seen. But as far as activity and the number of issues in the market, we expect it to be a very active year, given the current interest from capital markets investors in this product. The drivers of ILS issuance continue to be the same ones that have driven the activity for years. It's a diversifying asset. We saw through the financial crisis that, for the most part, ILS hung in there very well. There were a couple of defaults linked not to covered events, but to credit exposure to counterparties, which has been, for the most part, mitigated from the market under the current structures. But it's still offering an attractive yield, albeit tighter than it used to be years ago, but it's still, when you look at similar ratings and similar maturity types, the cat bonds are still paying rates that are attractive to the investors, and it also is a diversifying asset, because events are going to occur, but not necessarily, not going to be correlated to other credit events. Going forward, we expect market interest to stay as it is. The general question we've always asked is what happens if there's an event? And look, events occur. I mean, and they're supposed to, cat bonds are supposed to respond to covered events, and it's been pretty benign over the last decade or so. But if there's an event, we would expect investors to stay here. If there are even two events, it's what would drive, in our opinion, the investors away from the market is a series of unmodeled risks or events that weren't viewed as in the model set that occurred that caused people to question the modeling going forward. But events, that's just like any other investment. Sometimes there will be defaults, but it's really the questioning the modeling that we expect to the only thing to be driving investors away, because look, if there is an event, rates harden, it's still, so you'll be getting a higher rate of return. If again, interest rates, we would generally don't have an impact, because what is driving investors here is, I think, the diversification. While the rates are somewhat higher, by and large, these bonds are 3 to 5 year investments. You can turn over your portfolio at current market interest rates. So barring a sharp rise in interest rates, generally you would expect most investors to stay here, because again, some investors may go away, some of the people just have certain thresholds to meet, but again, if it's offering an attractive return and it can mitigate some lower returning investments in the remainder of your portfolio, there's no reason for investors to avoid this market. As you'll see in some other asset classes, risk modeling is the primary driver, in our opinion, of ILS issuance, because again, you're looking at events that are 1 in 50 years, 1 in 100 years, and it's kind of hard to say just by studying one's familiarity with the market what's a covered event. So people will look to the modeling. You see a lot of the cat bond light transactions where, look, it's just people will invest based on the model results. So that is a significant, risk modeling is a significant input into the ILS space. We expect the market to grow. Currently there's more capital than could be put to work here. Look, there are more risks out there than that have yet to be securitized. Look at the growth regions such as Asia, Australia, New Zealand. I mean, they have events. There was just recently a Cat 5 typhoon heading towards Australia. There were the earthquakes in New Zealand a couple of years ago. China's beset, and India are beset by natural perils. So there's no reason, once the models become more familiarized in the investment community, that that people won't put money to work there. So this is a growing market. And like I said, while we think there's a lot of capital out there, there's still a lot more risks out there that just need to be introduced to the market.
We'll have more of our coverage of SIFMA's IRLS conference in coming programs, so keep it here for more world risk and insurance news on RIN TV.